We saw three of the largest bank failures, banks fail here in the US, and that was Silicon Valley, First Republic,
Yep.
and Signature Bank. Guys, that was the tip of the iceberg. And those failures were not as a result of poorly managed business. It was a function of poorly managed maturities. They bought a lot of long-term bonds. The value of those bonds declined dramatically, and it made them essentially insolvent. So that triggered what eventually became a nationwide credit crunch. So banks, who provide somewhere between 40 and 70% of the debt to the commercial real estate business, have largely pulled back their lending. We know that empirically.
Tim is one of the most authentic and genuine people I've ever met.
I sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome, everyone, to today's Hero Capital Raising Show. I'm your host, Tim Mai, and today we have a special guest on the line with us. Meet Steven Shipp. Steven is a seasoned expert with an exceptional track record in the world of real estate and debt, with over 30 years of experience. Throughout Steven's journey, he has overseen the acquisition, financing, sale, and reposition of over $11 billion worth of commercial real estate assets and debts. It's staggering amount, obviously. Steve is an expert when it comes to, not only the market itself and the trends that's happening in the market, but raising capital from investors in the hundreds of millions of dollars to acquire all of these assets. And so with that, let's give Steve a big welcome, y'all. Woohoo! That's a
Hi,
Texas
guys.
welcome.
Pleasure
Steven.
to be here. Really nice to see every one of you.
Awesome. All right. Well, Steven, if you can share with us a little bit about you and how did you get into this world of commercial real estate?
Sure. I started my career at the ripe young age of 13 as a professional skateboarder and surfer. The last thing I thought I would do in this world is become a banker or an investment banker. It turns out I did, and it was one of the best things I'd done in my life. So I started off my career in total in the early 1990s as a very young vice president with Bank of America. Eventually, I went on to run several of the divisions within Bank of America that were focused mostly on non-performing commercial mortgages. And so, at the time, it was a $2 billion portfolio. And at the time, 30 years ago, that was significant. Today, not so much. As most of you probably are aware, there was recently a $60 billion portfolio of notes that was sold by Newmark. Anyways, starting with my Bank of America career, that's really where I launched into the world of commercial real estate, and was mostly distressed commercial real estate. So as a bank executive, I oversaw the resolution of billions of dollars. I went on to be CEO of what's known as a special servicing operation, which is when a loan is securitized by a mortgage-backed securitization process. There's a group known as the special servicers that attend to the mortgage if there's a problem with it, like there's a maturity default, debt service coverage ratio default. They make the material decisions on a distressed loan. So I spent a lot of time doing that. And then over the last 10 years, plus or minus, I've been managing very large portfolios on behalf of more than 10,000 investors. Over the last 5 years, I've bought more than $600 million worth of multifamily across the country. Although I will tell you, we stopped buying in roughly 2021, early 21, when cap rates got far too compressed. So my world today is all about distressed commercial real estate. Today, my firm, Performance Advisory Group, we work with borrowers who are facing defaults. We'll step in and we'll restructure their debt, whether it's a simple loan maturity extension or a full-blown restructure. We'll also execute discounted payoffs and note acquisitions. The objective really in that first bit of business that we do is to allow our clients to retain their real estate, avoid foreclosure, and live to fight another day. The second thing I do, which I really very much enjoy, is I do public speaking, teaching, and training on the subject of commercial real estate, particularly distressed stuff, because look, guys, the world of commercial real estate has changed dramatically over the last 12 months. It's a far different paradigm than we were in 21 or even in 2022. And learning how to adopt and to pivot into that new space is going to be virtually critical for anybody who wants to be a significant player. And then lastly, we're investors, guys. We have a fund that we're raising capital for today. The objective is to raise somewhere between 150 and $200 million over the next 6 to 12 months and invest in deeply discounted and distressed real estate, which is happening literally all over the country, all over the world, frankly, today. Being on the front line in the workout space, I see some of these discounts. And I can share with you later some of these transactions that we've been involved in. But look, we're seeing discounts on the multifamily side, especially a 50% decline from values of 2 years ago. And so we're players in that. Big picture, our perspective is that we're probably in the very early innings of this downturn, probably inning two. We won't know what inning exactly we're in until 2 or 3 years down the road, but we believe that this likely to be an extended down cycle, consistent with most, right? It's normally about 5 years from peak to trough in terms of value decline. And so we're not in a huge hurry to be big buyers in the marketplace, but we're supporting those who are big buyers, whether it's working with a lender to acquire a piece of real estate or a note, or teaching people how to participate and literally crush it. We look at this time that we're in today as once in a generational opportunity. So one of the classes I teach is called the Code to Generational Wealth. I do that through a mastermind group, which again, as you sort of get older, as you age and mature in this business in particular, you start to want to pivot and adopt and share with others the knowledge that you've gained. And look, one of my objectives over the next few years is to create thousands of new millionaires through investing in distressed and deeply discounted real estate because my friends, it's out there. We expect that distressed transactions will be the majority of transactions over the next 2 to 3 years. We know for sure, as an example, there's more than $1.5 trillion in maturing debt in the next 24 months alone, the vast majority of which is not refinanceable. So that just means that groups like ours will step in and will restructure the debt, whether it's a maturity extension or something else, or buy the note or recapitalize the transactions. So the world of
Wow,
distressed real estate is what we do.
that's awesome. And we're definitely gonna dig deeper into that for sure. It's fascinating to me. Let's talk about you mentioned that you haven't, you've been out of the market for the last couple years when the cap rate got too compressed. What else? I mean, and you got out like, perfect timing. I was almost at the very peak of the market at that time too. What besides the cap rate got compressed, what other factors did you notice that told you, hey, it's time to be out?
That's a great question, Tim. And my timing was not perfect. I missed a lot of the run up. I mean, we stopped investing in 2020 in the main, and that's simply because the Federal Reserve policy was, in my opinion, it was broken. They artificially reduced interest rates to effectively zero, which allowed cap rates to compress to the lowest cap rates we've seen in the history of the US. And we knew that was not sustainable. The Federal Reserve, on top of reducing the interest rates to, again, effectively zero, they flooded the market with liquidity. And this is the biggest thing that scared us. If you look at a chart of what's known as M1, which is the primary money supply in the US, it went from $4 trillion. And by the way, M1 is the money supply that's in circulation. It's the money in your pocket, in your bank account, safe deposit box, whatever. It's the money that's relatively available. It went from $4 trillion to $21 trillion in just over 12 months. Everybody got rich. There was a ton of liquidity in the marketplace. That combined with extremely low interest rates caused the value of virtually everything, whether it's single family homes or automobiles or commercial real estate, price of lumber, equities, whatever. The average asset value went up 40% in less than 12 months because of what we think is deeply flawed Federal Reserve policy. And that was just simply not sustainable. We knew that it had to reverse, and we knew that when it reversed, it was going to be very, very painful for our economy. And that's exactly what we're seeing, guys, between transactions falling off in both commercial real estate and single family real estate, and inflation, and now a massive credit crunch in the banking and the CMBS industry, it's a challenging time, but it's also huge opportunity. Like I said earlier, I think it's a generational opportunity to acquire real estate at deep, deep discounts.
I see. Very, very cool. So let's dig into your world. With you being on the note side of the business, are there activities that are happening on that side that you see before we see it on this asset side?
Yeah,
Like you start to see it. So with what you were mentioning, with the interest rate dropping, the Fed policy, what were you noticing on the debt side of the business to also have had signal that, hey, there's something happening?
right. Another good question, Tim. You're very good at this, by the way. We
Thank
know
you.
that earlier in 2023, we saw three of the largest bank failures, three of the large four banks fail here in the US, and that was Silicon Valley, First Republic,
Yep.
and Signature Bank. Guys, that was the tip of the iceberg. And those failures were not as a result of poorly managed business. It was a function of poorly managed maturities. They bought a lot of long-term bonds. The value of those bonds declined dramatically, and it made them essentially insolvent. So that triggered what eventually became a nationwide credit crunch. So banks who provide somewhere between 40 and 70% of the debt to the commercial real estate business have largely pulled back their lending. We know that empirically. That's caused a credit crunch. And so it's extremely difficult to go out and get new debt on something like an office building or retail center or a hotel. And that lack of liquidity, guys, in today's marketplace means that values will continue to decline. They'll probably do so for some extended period of time. So we also know this, that banks, to repack some of the liquidity on their balance sheets, you've heard of the flight of deposits, right? Banks have been losing deposits in the trillions of dollars all over the course of the year because somebody could take their money out of a bank where they were earning 1% and invest it in treasuries and earn something in the 5% range, a 500x on their deposit return. So between flight of deposits and declining credit quality of their loan portfolio, these banks are essentially in trouble. And so many of them are
Mm,
frankly fighting to survive. So we don't expect this credit crunch to resolve itself at any time here in the near future. That means that one way they can recapitalize is by, or put new cash on their balance sheet, is by selling these notes, whether performing or non-performing. And that note sale process is very, very robust today. We know, again, as I mentioned earlier, that Newmark marketed at $60 billion worth of notes. That number is just mind-boggling. And
wow.
that was really just Signature Valley Bank, their portfolio of notes. And it was largely in the New York area. And so that note sale process really, not only is it the biggest we've ever seen in the history of note sales here in the US for commercial real estate related notes, but it's really just the start. The easiest way for banks to put liquidity on their balance sheet is to sell notes. And so that transaction volume is very, very significant today. I hope that answers your question, Tim.
It does. It does. Share with us what your crystal ball is telling you. I know you mentioned we don't know what the bottom is, until it plays out further. But if you kind of give us a time frame, what it might look like based on your years of experience, and I know you've been through several of these cycles. What does the next 5 years look like for our industry? Start there, and then we're gonna dig into the different asset classes and to see,
Sure.
how certain asset class will be more affected, than others.
So my crystal ball for the next 5 years, it's very murky, but I can tell you that historically, again, from peak to trough, peak being somewhere in mid 2022 for values, commercial real estate. It's also potentially the peak of the equities market, whether it's, the S&P or NASDAQ or whatever. It's about a 5-year cycle. It's a 5-year from point to trough, it's about 5 years. So again, we think we're in the early stages of this process. One of the things that becomes readily apparent when the market is in distress or at least deeply dislocated is that values will take a period of time to decline. We know empirically that sellers will work harder to avoid a loss than they will to realize a gain. And that psychology is occurring very much in today's world. Now, one of the biggest drivers behind the complete fall off in transactions in our world today, aside from the lack of lending, is what's known as negative leverage. Negative leverage happens when the cap rate is lower, arguably lower than the cost of your capital. So the reality is you should have a better return on your real estate than what you're paying for the loan against your real estate. But that's not what's happened today. We're in a period of negative leverage, which hasn't really happened in a very robust way since the late 1970s, believe it or not. It's not sustainable. And so at this point, we're seeing cap rates. Well, let me just say this. It resolves itself. It always does. And it will, and it generally will take less than 2 years, but it resolves itself in two different ways. Either interest rates will come down or cap rates will go up so that cap rates are higher than the cost of capital. Normally that spread between cost of capital and cap rates is about 100 basis points at least. That we'll get back to that point of resolution or where it fully gets resolved. It just takes a period of time to get there. And in the meantime, transaction volume has fallen off dramatically. Let me give you a good example. A lot of people I hear are known for their investments or want to be deeper into the investment in multifamily. A friend of mine is the chairman and CEO of one of the nation's largest multifamily investment platforms. This year, 2023, his pencils were, quote, down. That means he's only done 12 deals this year, somewhere in the $400 million range. Only reason he got those deals done, guys, is because the seller carried back financing that was better than market rates. So even though he paid a 5 cap, which is still on a relative basis very low, the seller carried back a note in the 4.5% range.
I
So he got
see.
positive leverage because the cap rate, we had that inversion, which was appropriate, and he was able to get those deals executed because one, they've got a deep capital base. They work with many institutional investors. But again, these guys are the best and brightest in the business. Their pencils are down, excepting when you can do something better than market. In that case, it's like a higher than market cap rate or lower than market interest rate.
Right.
Makes
W-
sense?
Yep, it does. So what about, inventory? I know you mentioned that there's a lot of default happening. Um, you guys are working on, workout programs for some of those, and then maybe even, I guess, when you can't get the loan workout to work, then most likely those assets are going to go on the market for sale. Is that correct? Is that how it works?
Yeah, that's exactly correct. And so let's start with the first part, Tim, which is what's going on from a loan default perspective, because loan defaults will drive distressed transactions. Every loan default results in a transaction, whether it's a simple loan modification or a appointment of receiver and foreclosure or the sale of a note. It will result in a transaction. And so we think that over the next 3 years, there's going to be something close to $2 trillion of nothing but distressed transactions. They don't happen all at once, obviously. And we've seen that like over the last 6 to 12 months, most commercial lenders and special servicers have been granting simple extensions. They've been allowing the borrower to have some runway to try and resolve some of their issues. That window is starting to close today. So lenders are being more aggressive in their collection efforts on loans that are defaulting or likely will default in the near term. That process of foreclosure and resolution of a defaulted loan can take years to play out. But here's what's really important when we're in a cycle of distress. You end up with a downward spiral in valuation. So let me give you a prime example of that. There's 4 office buildings in, call it a downtown market. Los Angeles is an example, by the way. Downtown Los Angeles office product, even the Class A stuff, is deeply distressed today. So four office buildings, they've all were acquired, say, in the last 5 years. They all have fixed rate long-term debt that's fairly highly leveraged. Somebody comes in and buys the fifth property, but they buy it at 20% or 25% the basis of their competition. So they own the building for far less than what's known as their competitive set. They're able to offer lease deals and transactions that are far, far, far below market, driving the average leasing expense for a tenant way, way down. And when that happens, you end up with what is known as a death spiral, where somebody else will lose their property to real estate. Somebody will buy that defaulted property for even less and offer the lease rates for even less. Well, that same concept applies in every asset class: multifamily, industrial, self-storage, hospitality, office. It doesn't matter. But that process, this takes a while to play itself out, and not just months. It will take years. If historical cycles are prove themselves to repeat, now we know that history doesn't actually repeat, but it sort of resembles itself. There's a lot of correlation. It rhymes. You've heard the old adage, history doesn't repeat, but it rhymes. And if history rhymes with historical cycles, the ones I've been involved in, this will be my fifth. It's going to
Wow.
take about 5 years to play out. I know I'm sharing what might be perceived as bad news. It's not. Negative cycles happen. Any economy goes through cycles, and this is a natural resolution, particularly after what the Federal Reserve did to us or for us in terms of injecting all that liquidity and stimulating our economy in the middle of the worst pandemic we've had in 100 years. So down cycles are natural. I will tell you, every down cycle, there are a handful of people within every organization that don't just survive, but they thrive in the downturn. They learn how to pivot and absolutely crush it because of making the right relationships and making the right moves. So it's not bad news. Again, it's very, very opportunistic, and it's potentially once in a generation opportunity for you.
Right. Can you share with us the motivation of the lender on situations when they would consider a workout program or some type of negotiations versus when they won't? And here's where I'm going with that. So, I follow the news a little bit especially for the multifamily industry. I know someone here in the Houston market with the exact same lender that was not willing to negotiate with him at all and proceed with the foreclosure. And that lender with another operator out of Phoenix with ton more properties with that same lender. And so they were able to get the workout program. And I mean, so volume apparently has one thing to do with it. They don't want to take back, $1 billion worth of real estate in one shot. But they are willing to take back, I don't remember how much this is, but it's in the tens of millions of dollars, on one asset. So share with us some of their reasoning or incentives, like how they make that decision. Can you share? Yeah, give us your insight into that.
Yeah. And this is the space that I know really well because, again, I was a bank executive and I was the CEO of a special servicing group. I know how they operate, which is one of the things that gives us great insight and ability to execute on behalf of our clients. That's not a pitch. It's nice being an insider in that space because you know their motivations. And so if there's a lender and the loan is in default, they have across the board a universal goal and objective, and that is to minimize losses and maximize recoveries of the loan on a net present value basis. And so if the lender thinks that they can sell the note today at more than they could sell the property for after they foreclose, and in Texas, the foreclosure period it can be less than 30 days, but that's an anomaly. In New York, it could be more than 2 years, or New Jersey, it could take years. And that's not even considering bankruptcy. So the lender's primary objective is to minimize losses, maximize recoveries on a net present value basis. So they look at their options and they say, okay, if we allow this property to go to market with a full OM offering, we can get close to market value for the real estate. And we can make it happen on a relatively quick basis. So sometimes that might be their objective. Oftentimes, particularly in today's world, especially in multifamily, any multifamily that's been acquired over the last, call it 2 to 3 years, they're going to take a loss. So lenders are willing to take a loss, guys, as long as the loss they are taking is manageable both from a balance sheet perspective and from a strategy perspective. In other words, they need to make sure that that's a good loss they're taking. There's a lot of lenders out there who, frankly, don't want to own real estate. If my hypothesis is true and that it's going to take years for values to hit their bottom, and that's a point of what I call capitulation, then a lender's not willing to take the time to foreclose on a property and own it for an extended period of time. That's like catching a falling knife. They don't really want to be in that space. So they're looking for alternatives to do it. On the other hand, if a lender thinks that what's going on with a piece of real estate is a short-term problem, and that given time and additional capital investment, the property will recover in terms of both cash flow and valuation, then they might be willing to grant an extension. So, Tim, I will tell you that every lender has their own set of motivations. Generally, again, it's minimize losses, maximize gains on a present value basis. But there's distinctions for various lenders. I'll give you an example. There's one of the largest bridge lenders here in the U.S. was very aggressively lending against multifamily. They collateralized a lot of those loans in the form of a CLO. We think the value of the firm itself that did all these securitizations is effectively zero today because those loans have zero value because the loans are upside down from a loan to value perspective. The loans here, the value of the real estate's here, given what's going on with cap rates and given what's occurred with interest rates. So it's really difficult, Tim, to give you a really good statement on lender motivations. But again, lenders who are prudent will try and minimize their losses. And if a short-term maturity extension makes the most sense and they have faith in the borrower, then that's likely what they're going to do. I've got a book on this subject. If you guys would like a free copy of my book, send me an email. My contact at Steven at Performance Advisory Group, and I'll send you the book. It walks through all these issues that you're bringing up, Tim, which are really, really important, especially in today's marketplace. Knowing how to negotiate with a lender will literally make the difference between you being super successful or maybe not even surviving this downturn as a business person. Super important.
So share with us about your business model. I know you help clients work out these things. Like how does your business work?
So, like I said, there's more than $1.5 trillion in maturing loans, the vast majority of which are not refinanceable today. So client will come to us and say, look, if I can give you an example that might make it easier. Is that okay, Tim?
Yep,
of
course.
Okay. So a gentleman who's now a friend of mine, his family trust bought a assisted living facility in Southern California in 2019. They bought it for $27 million, and then COVID hit, and it drove values through the floor. They bought it at 27. The bank appraisal came in just about a year ago at $12 million, more than a 50% reduction in value. They owed $18 million on this piece of real estate, and there was a $1 million recourse component, meaning that if they sold the real estate for $12 million, they had to make up out of their own pocket that $6 million recourse liability. The loan was in default. It was likely to go to foreclosure, but that's never a good solution for an assisted living facility, anything like that, because it further depresses valuation, cash flow, occupancy, etc. So they brought us in. They said, look, we're in trouble. The value of my family trust is about $8 million, and that's what the bank is threatening to come after us for. We've already offered them $1 million, and they said no. So they thought the loan, the settlement was in the $2 to $3 million range. So here's what we did. We know this is a regional bank, by the way, I can't name, but It's a regional bank, and they were being pressured from a earnings and balance sheet perspective. So they wanted this bad loan off their books. So they said, all right, we'll consider a $12 million payoff, but we want you to write us a check for $3 million. And we said, here's what we're going to do. In the next 30 days, we're going to bring in a buyer, which was an affiliate of our company, to buy the real estate at $12 million. You get all the proceeds from that settlement, and we'll get it done by quarter end. And then we're going to write you a check for $250,000. If you don't accept that deal, we're going to force you to foreclose on the real estate, which could take months, potentially involve a bankruptcy, and further devastate the operations at the real estate. And you could come after the family trust and essentially wipe out all of its assets. You're likely to bankrupt that because there are other real estate investments there that need their additional capital. So we put it to the lender and said, look, we think it's in your best interest to allow this discounted payoff at 12 million bucks. You will take a loss. We'll make this happen in less than 30 days. And by the way, we'll write you a check. And so we got that done. And that's kind of, look, that's a miracle that we don't get to perform every day. But when we do, we have a borrower that's just absolutely ecstatic. So it's not just settlement of recourse liabilities. It's also situations where a client just needs to extend a loan because there's nobody else that's going to refinance it. And so we'll step in and do that. Or maybe interest rate reduction. There's a variety of ways to deal with this defaulting debt. And look, I'm passionate about it. I'm obviously geeking out on this whole distressed commercial real estate world. That's what I've lived in most of my life, and I'm passionate about it. So helping borrowers with these major problems is something that we really enjoy doing, and we think we're pretty damn good at it.
Right. That's awesome. Is there a certain, size of the project before you get involved? And the reason why I'm asking that is I do get people coming to me with, some type, like help them raise more money. I'm considering setting up a rescue fund. And so when a lead like that comes to me and their deal is in trouble, or they need extra money for operations capex, or they need extra money for the the cap.
Yeah, got it.
Yeah, so how would I know who is a good fit for what you have?
Well, it's any borrower who is facing either in default or facing a default. We help them actually understand their situation. So understanding whether the loan's recourse or non-recourse, whether there's any equity there to protect. Because in a lot of situations, guys, the loan amount can be here and the value of the real estate is down here, and it doesn't make sense to invest new capital. So as an example, we do get a lot of calls from LPs. They're saying, hey, my GP wants a capital call. Can you help us understand whether or not it makes sense? And some of the times it makes sense. Sometimes it doesn't make sense. So we get involved. I mean, look, I personally do 15 to 30-minute strategy calls with anybody who wants to set up time with me just to understand their situation. And like I said, this is one of the things I'm passionate about. I don't want to see family or an individual lose a piece of real estate because they didn't have the right tool set. They didn't know how to ask the right questions. It's a certain special set of skills that we bring to the table that they're not very well known in today's marketplace because we've been in a very good economic cycle for an extended period of time. But there are important, again, if you like a copy of my book, I'll send it to you. It is valuable.
Yeah, and I put your email in the chat. Right, that's awesome. Is there a certain, size of the project before you get involved? And the reason why I'm asking that is I do get people coming to me with, some type, like help them raise more money. I'm considering setting up a rescue fund. And so when a lead like that comes to me and their deal is in trouble, or they need extra money for operations capex, or they need extra money for the the cap.
Yeah, got it.
Yeah, so how would I know who is a good fit for what you have?
Distressed assets and assets that are deeply discounted from historical values. Let me just give you a prime example. Downtown San Francisco has been devastated for a variety of reasons, but the office building market is off more than 80%. So something that was selling for
Mm,
$100 million in 2018 is now worth $20 million. That's as it stands today. And that's in the financial district, downtown San Francisco, which is it's a gateway city. If your business model says we're going to target assets like that, and by the way, you can use multifamily as an example. We can go into more detail on the multifamily side, but because multifamily is deeply distressed, there's a wave of CLO defaults and bridge loan defaults that are going to bring massive, massive opportunity. So when you're in a down cycle, the key word should be distressed real estate. And if you're opportunistic, which if you want to play in the market, I strongly suggest you only look at opportunistic deals. Then talking about a business model that says we're going to buy using mostly equity or some form of sustainable bridge debt, distressed real estate. We're going to add value to that distressed real estate by capital improvements, repositioning the asset, adding occupancy, etc. That business model makes sense. And so the easiest way to raise capital from that perspective is your existing relationships. If you already have raised capital historically and you've done a decent job for your investors, going to your existing pool of investment possibilities is obviously the first step. We have done most of our raises through family offices and institutional investors, but there's also a big world of tenant in common and DST investors out there that are ready to move their money into an alternative investment simply because they have to. So first thing I try to point out here was that if you're raising capital to invest in commercial real estate today, it needs to come with a handle of distressed and deeply discounted, because that's going to be the vast majority of transactions here over the next 2 to 4 years. And then go to your existing clientele base, those that you've raised capital through before. That's got to be your first pitch. And then if that's not successful, look, there's crowdfunding is not a bad idea these days. There's really, really effective and efficient ways to do that. If you'd like more detail on it, I'd be more than happy to have a quick call with you as well.
that's awesome. Based on your experience in the different market cycles that you've been through, would you say that this market that we're coming up in, that it is more challenging to raise capital than when like versus the last few years? And
Yeah.
so knowing that it's going to be more challenging, what are some of the things that we can do to make it less challenging and still still raise the money?
It is definitively going to be more challenging simply because in 21 and 22, there was so much liquidity in the marketplace and everybody wanted to be involved in, as an example, multifamily, because historically that's been the #1 asset class from a returns perspective. And so it was really easy to raise capital. I have friends that, well-known friends, you'll know their names. If I mention them, they're on TV, they're doing seminars, they're teaching people how to raise capital, and they've been very successful. Part of the problem was that they were almost too successful, and there was too much money dumped into the multifamily market, which I'm sure all of you heard the stories. And so that's coming back to bite us at this point. Cap rates are floating up, and look, it's one thing to go from a cap rate of 5% to 60% or to 6%. That's about a 20% decline. But if you go from a cap rate of 4% to today's market of somewhere around 6%, that's a 50% decline in value. So easy to raise capital over the last 2 or 3 years, very difficult going forward, unless again you have the right story. And the right story has got to be targeted assets. And here's one of the rubs when you're in a world of distressed commercial real estate. And by the way, you might or might know this, there's $300 billion worth of capital on the sidelines ready to invest. Now that's the KKRs, the Blackstones, the BlackRocks, the Starwood Capitals. That money is sitting there on the side. So a couple things I want to share with you. One, you need to fly below that radar if you want to be an investor. And two, your investment plan needs to make great sense and show returns that outpace historical market returns, given the fact that you're going to be buying some of some of these assets at deeply discounted and distressed prices. And that's available out there. The problem is this: the average person probably on this call, and I don't know this empirically, is going to try and raise money for a single transaction, right? They'll identify the deal, they'll try and put it under contract, and then do their capital raise. In the world of distress, it's super important to be liquid as you possibly can. That means have money that you can call on for the right circumstances that says, look, I've got a couple multifamily deals that I'm looking at in the Dallas market. Their loans are matured, are in default. The lender's likely to foreclose. They're looking for solutions around that. We could step in and buy it at a 20% discount or a 30% discount to market pricing of 2 years ago. We don't know which asset we're going to get. We just want to know that if we can tie one of these deals up, that you're a potential investor. So it's got to be asset specific for most of us. It's got to have the handle of distress or deeply discounted on it. You've got to be able to move relatively quickly. And you've got to be, here's something that's going to be super important. You've got to be realistic about your
Mhm.
pro forma. We know that one of the things that's happened over the last couple of years is that the pro formas that a lot of sponsors were putting together were not realistic. They showed exit cap rates in the 4% range. Not realistic. Cap rates need to be more likely than not, and this is not empirical, but it's more likely than not, they need to have a six handle on them. If they don't have a six handle on them, you're not likely to gain a lot of at least astute investor interest. Because again, that negative leverage thing doesn't work, not on a sustainable basis. So does that help, Tim?
It does. It does a lot. Um, yeah, and I've, kind of like what you're saying here. We definitely, even in today's market, definitely seeing some that are underwriting in the 4+%
Yeah.
for
But
sure. Yeah.
look, it's got to be. There's a lot of real estate on the market today that's just sitting there because the cap rate is simply too low. If you buy at a 4 cap and you're paying 6%, you're losing money. The more you borrow, the more you lose. And expecting rents to lift to take you out of that negative leverage situation is not a realistic pro forma. It's not likely to succeed. It could, but look, the fact of the matter is we are slowing down as an economy. All that
Mhm.
excess liquidity the Federal Reserve dumped into the marketplace is largely gone. So our ability to pay an extra $100, $200 a month in rents is likely gone. In fact, we're starting to see rent reversals in many major markets here in the US. And so hoping that rent lifts is going to dig you out of a problem is not a likely or viable business plan in most situations. Now, look, a lot of these distress assets suffer from things like lack of capital. So they haven't been able to turn units. So the occupancy is down, vacancies up.
Mhm.
The curb appeal doesn't look good because they haven't been able to maintain landscaping, and building needs painting, the parking lot needs paving and striping. So these things do exist out there. And so you can add value just by doing simple capital improvements and turning units over or improving and then leasing these units up. That's very possible. In fact, from my perspective, guys, and historically, that's exactly what we've invested. We've invested in deals, not just because the cap rate was 100 basis points or 200 basis better than market, but because we saw some intrinsic challenges with the real estate that were solvable by just investing some new money,
Mm,
painting the buildings, turning over the units, etc.
I see. What about, your experience with the family office money? How, how optimistic, well, that's not the term I'm looking for, but how open are they in investing in multifamily commercial real estate assets at this time?
Well, I think it depends on who you talk to. Most family offices bring a level of sophistication to the table, and that level of sophistication has been learned over a period of decades. And so they've seen cycles up and down, and they tend to play the cycles right down the middle. So our existing family office relationships are ready to jump in. They see these extraordinary opportunities that I've been talking about, and they're ready to invest with the right sponsor, though. Managing in a downturn, guys, is very different than managing during an upswing in an economy. So, prime example, in 2008, I took over a multi-billion dollar investment platform here in Southern California. I'm from Laguna Beach, by the way. Um, and we had several hundred employees. We were losing tens of millions of dollars a year. And that's
Mm,
because they hadn't shifted cycle. They haven't shifted mentality based on the economic cycle. So we retrained them to think like an asset manager in a down market. We showed them how to deploy capital strategically. So big challenge that we're facing today, guys, is there's a lack of market depth from a sponsorship perspective. And that lack of market depth is going to bring opportunities to people like you and me if we play our cards right. So family offices, they are players all day long. You just got to bring the right model, you got to bring the right asset, and you got to bring the right sponsorships to the table.
gotcha. All right,
Yeah.
a little side topic here. So I've been wanting to host an event that would attract family offices there. Ideally, because I attend some of these events, and it seems like, maybe only 20% of the audience is actually family offices, and the other 80% are operators like myself.
Looking
And
for
so I've
family
been,
office investors, right?
yeah, exactly. And so I've been thinking about how, and I'm not familiar with the family office space, but I want to, get my feet into that world. And I know hosting events is a good way to do that. So I've been thinking about hosting an event that would that primarily is for family offices, and we'll still have a few, invitation only for the operators to come in, so that way there's some kind of deal flow there. But it's more of a it's more of an event for family offices to meet their peers and kind of compare notes and stuff like that. Um,
Sure.
how do you think I can best do that? Like, how can I set up the event in such a way that would attract family offices to come and show up? Like, what are they looking for? What are their needs or wants?
Yeah. So it's got to have a great hook. And again, family offices tend to be sophisticated and more likely have been around for an extended period of time. I'm working with a group. I'll just give you an example. I'm working with a group that sold their family enterprise for a couple $1 billion in the early 2000s. And
Wow.
they've done really well from an investment perspective in commercial real estate, although they have a very large portfolio of product that need to be restructured because the loans are maturing and it's going to be a problem. I've shown them the opportunity. I've walked them through what the next few years are going to look like. And again, if I can impart anything to you guys, it's the fact that over the next few years, generational wealth will be created. There's more wealth made during a downturn than there is during an upturn, which is meaningful because 70% of the wealthiest families here in the US earn the vast majority of that wealth through investment in commercial real estate. So a lot of them are licking their chops. A lot of them are looking for the right opportunities. They don't want to manage the assets. They want to invest the capital and trust management to run the asset prudently. And so, Tim, difficult question to answer. I would say that where I'm going with that is that it should have the tag distress to it. It should have the idea that you're building uh, an enterprise, or I'm sorry, an environment that's going to be mostly focused on distressed real estate, because that's really where the
Mm,
opportunity is. Buying
I
retail
like that.
today, to me, is ludicrous. Let's just go out and raise capital and buy this multifamily building at a 5 cap. Well, yeah, it's maybe 100 basis points better in cap rate than it was a year ago, but it's still not at a level that I find appealing at all. There's going to be. I'll tell you this story because um, it's important for you in the multifamily space. There is several $100 billion in maturing bridge debt that's tied to multifamily that has been originated over the last 3 years. And that's going to cause a flood, an absolute flood of distressed multifamily onto the marketplace. How you manage that is really up to you, but you've got to learn the business of managing and buying distressed real estate. It's far different than it was a year ago. You can't just raise capital and go make an offer, sign the PSA, and close in 30, 45 days after you raise the capital. You've got a third party here involved, and that's the lender. The lender controls the purse strings because more often than not today, they're in a loss position. They have to choose who they're going to take that loss with and what that loss looks like. So learning the business of distress, Tim, is going to be absolutely critical. So if you want to bring a group together, it should again have this focus of distress. Now, I'm sure that I sound like
I
a
like that
broken
idea.
record. I'm sure that I do. But the reality is,
do.
guys, that's right.
Yeah, no, yeah, you're right. And I like that idea a lot. So what about like at least right now anyways, the properties that I see being foreclosed on are primarily, Class C type assets. I haven't seen much Class A's and B's being foreclosed on. Are you seeing that differently from the note side of it?
So you're saying you think most of the distress is on the Class C side?
Yeah, uh-huh.
I'm not sure I can give you the data that you're looking for there, but I will tell you this, that the vast majority of multifamily out there is Class B, right? You build, so if it's Class A, it's relatively new construction.
Hmm.
And it's that Class B stuff, either C or C plus or B or B minus, that
Hmm.
people have been investing in for years to new countertops, new flooring, new appliances, upgrade the amenity package, and raise rents by $200 to $300 a unit. I did hundreds of millions of dollars worth of that stuff. I know that well. But it's in that's focused primarily on space that is C plus to B minus, or even
Hmm.
B that you can move a notch better just through capital improvement. So I don't think, Tim, it's going to be limited to Class C. And here's the other thing. In a down economy, it's not the C class that struggles the most. It tends to be because they tend to have the most stable tenancy. It tends to be stuff in the B range, non-core assets or core assets. That makes sense?
It does. It's interesting.
Good.
It does. Awesome. All right, Stephen, we're going to be wrapping up this part of our show today. For the folks that want to reach out to you, connect with you, get your book, all of that good stuff, where would you like to send them?
Yeah, easiest thing to do is connect with me via my email address. It's again Steven at Performance Advisory Group. From there, we can set up a call. I can send you a copy of my book. I can send you to my YouTube channel. We're just really starting to blow up our YouTube channel. There's also connect with me on LinkedIn. I spend more time there than virtually any other space in terms of social media. So connect with me for sure on LinkedIn. I've just created a new group called Distressed Real Estate Mastermind. I suggest you join that. Again, it's relatively new, but my expectation is we're going to really blow that up. I want to use that as not only a means by which I can impart knowledge, but also share potential investment ideas and even properties. So I want it to be a robust marketplace. That's my ultimate goal and objective. So that's the way to go. Hey, thank you, Tim, for putting that on there. Good.
Very cool. Awesome. All right, Stephen, again, thank you so much for being on this show with us. Really enjoyed this interview. It's been a wealth amount of knowledge and wisdom that you share. So really appreciate you for being on the show with us today.
Absolutely my pleasure, guys. It was my honor to be here. Thank you, Tim, for inviting me. And I hope you can walk away, my audience here, with one or two tips that will serve you well. So best of luck and blessings.